ETFs versus index funds. The simple wealth system most people never understand. Most people believe investing is complicated. They think it requires predicting the stock market, analyzing charts, and reading financial news daily. However, many of the world's most successful investors quietly follow a much simpler strategy. They invest directly in broad segments of the economy. Then they remain patient. They wait. No constant trading. No guessing. No gambling. They rely on structure, discipline, and time. Today, we will explain ETFs and index funds in the simplest way possible and show why understanding the difference could fundamentally change how you think about money. For decades, people once believed that hard work and saving money would ensure financial security. However, the financial system has changed. Inflation quietly began reducing the value of money over time. As a result, the same paycheck now buys less food, less housing, less energy, and provides less financial freedom. This shift has compelled millions of people to invest, not because they aspire to become traders, but because remaining financially stagnant became risky. This development led to a large industry built on a single promise: grow your money at a rate that outpaces inflation. This is where ETFs and index funds become relevant. But most people hear those terms and immediately feel confused. This confusion often arises because finance uses complex language to describe simple concepts. An index fund is designed to follow an index. For example, the S&P 500 tracks 500 of the largest companies in America. An S&P 500 index fund automatically invests in those companies. Instead of trying to predict which company will succeed, the investor owns shares in many companies at once. This approach provides diversification. If one company underperforms, the overall portfolio remains stable. Historically, broad index investing has often outperformed many actively managed funds over extended periods. This result surprised many in the financial industry. Despite the resources of professional fund managers, who have access to research teams and advanced models, they often fail to consistently outperform simple index investing after fees. This raises an important question. If even experts struggle to outperform the market, why do so many individual investors continue to try to outsmart it? Here is where much of the confusion starts. An ETF, or exchange-traded fund, is not necessarily an investment strategy. It is an investment structure. Consider an ETF as a container. Within this container, you can hold various types of investments: stocks, bonds, commodities, indexes, even cryptocurrencies. ETFs trade on stock exchanges just like regular stocks. This allows investors to buy or sell them throughout the trading day. Many ETFs are also designed to track indexes. As a result, some ETFs are index funds. This overlap often leads to confusion between the two terms. An index fund describes an investment strategy. An ETF describes how the investment is packaged and traded. Once people understand this distinction, the financial system becomes much easier to understand. Let's examine the practical differences. Although ETFs and index funds share similarities, their structure affects how investors use them. Index funds are often ideal for investors who prefer a more hands-off system. Many allow automatic contributions. This allows investors to automatically invest small amounts on a regular basis. For example, with each paycheck, each month, or each year. This approach builds consistency. Consistency is a powerful factor in investing. Index funds are especially attractive for long-term investors who do not care about intraday trading. They aim to invest steadily over time. ETFs operate differently. ETFs trade like stocks during market hours. This provides investors with greater flexibility and control. ETFs also typically have lower management expense ratios, often referred to as MERs. Lower fees may seem minor, but over decades, fees can compound significantly. According to Business Insider, ETFs often appeal to investors making larger, less frequent purchases because of their lower costs and flexibility. ETFs also usually have no minimum investment requirements, real-time trading, and broader accessibility through investment apps. In contrast, Index mutual funds may be better suited for investors seeking automatic investing and simplicity. The better option depends less on intelligence and more on investor behavior. Some investors prefer automation, others value flexibility. Some investors appreciate simplicity and routine. Others seek lower fees and greater control. Both approaches share one essential principle: long-term ownership. This may be the key to successful investing. The greatest risk in investing is often not the market itself. Instead, it is human psychology. Emotional decision-making can undermine sound investment strategies. Investors often buy during periods of excitement, panic during market downturns, and chase trends during speculative bubbles. Social media has significantly amplified these behaviors. Every day, someone online claims to have achieved instant wealth: crypto, options, day trading, leverage. However, long-term investing rarely appears exciting. This is precisely why many investors abandon it. Patience can feel slow and unrewarding. Yet historically, compounding has rewarded disciplined investors far more consistently than emotional speculation. The market often transfers wealth from impatient participants to patient participants. Many people misunderstand investing by focusing excessively on prediction. They often ask questions such as, what stock will explode next? What will the market do tomorrow? Is now the perfect time to buy? However, the underlying reality is less comfortable. Very few people can consistently predict markets. Even professional investors struggle. Entire financial institutions, with analysts, algorithms, economic models, and billions of dollars, still fail to predict markets consistently over extended periods. This is where many individual investors make their most significant mistake. They assume wealth is achieved through intelligence alone. In reality, wealth is more often the result of disciplined behavior than accurate prediction. Investing is not solely about selecting assets. It is also about maintaining your position long enough for compounding to take effect. Compounding is one of the most powerful forces in finance. However, from a psychological perspective, it is difficult for people to fully appreciate. In the early stages, the results are almost imperceptible. You invest small amounts. The growth appears slow. This can feel discouraging. A few dollars, tiny gains, minimal progress, and many people quit during this stage. This is not due to a failure of the system, but rather because people naturally seek immediate rewards. Modern society trains people to expect speed, fast entertainment, fast delivery, fast success. However, wealth rarely grows significantly at first. Real compounding behaves differently. For several years, progress appears small. Eventually, the curve begins accelerating. Suddenly, what once seemed insignificant becomes highly impactful. This is why starting early matters so much. This advantage is not due to greater intelligence among young investors. Rather, it is because they have something older investors cannot regain. They have time. Someone who invests modest amounts consistently over 30 years may outperform someone who invests aggressively for only 10 years. This is because time amplifies the effects of consistency. This perspective shapes how thoughtful investors approach the market. They avoid focusing on short-term predictions. Instead, they prioritize staying invested, controlling emotions, minimizing fees, and remaining patient during volatility. Historically, markets have rewarded long-term ownership far more consistently than emotional trading. Every financial crisis creates fear. This fear often leads to emotional decision-making. During market downturns, many investors panic, mistaking temporary declines for permanent losses. However, history shows that many market crashes eventually become distant memories. The investors who persevered were often not the most knowledgeable. They were the most disciplined. Successful investing often depends more on emotional discipline than on the ability to predict market movements. This is challenging because human instincts often conflict with sound investment practices. When markets decline, fear encourages investors to withdraw. When markets rise, greed prompts them to pursue gains. This emotional cycle has repeatedly undermined the success of millions of investors. The market consistently tests our patience. It tests discipline. It tests emotional stability. It tests long-term thinking, which is why investing is not only a financial activity. It is a psychological challenge against your own emotions. This may be the greatest insight that many people overlook. Wealth is often built quietly. It grows slowly, almost invisibly, until eventually the results become impossible to ignore. Not because someone predicted the future perfectly, but because they respected the value of time more than others. Those who build lasting wealth often recognize a simple principle. However, this understanding is uncommon. Wealth grows most effectively when discipline endures beyond emotion. Time is essential to this process. It is a driving force that enables lasting results. The financial industry frequently promotes complexity. However, wealth is often built through simple, effective systems. Consistency, ownership, patience, discipline, time. ETFs and index funds are not shortcuts to instant wealth. They are tools for millions of individuals. These tools may provide one of the simplest available paths to long-term wealth building. It is important to be clear about one point. Investing always involves risk. Markets rise and fall. Past performance does not guarantee future results. This documentary is intended for educational and informational purposes only and should not be considered financial advice. Every investor has different goals, different risk tolerance, and different financial situations. Always do your own research and consider speaking with a qualified financial professional before making investment decisions. Because real investing is not about becoming rich overnight. It is about creating a structure resilient enough to withstand uncertainty over extended periods. This may be the deeper lesson that is often overlooked. Financial freedom is rarely built through constant excitement. It is often built quietly through disciplined practice consistently over many years. If this documentary clarified the difference between ETFs and index funds, please share it with someone who may benefit from financial literacy. You are also invited to subscribe to this channel for more documentaries on investing, personal finance, economic systems, and the psychology of wealth.